what ARV means is if the house were in its after repair condition, that is comparable in likeness, in style, in finish to all the other properties in the neighborhood that are for sale competing with you, what would that number be? And of course we have to figure out what it's going to take in terms of fix-up money to get there. But we have to start with the assumption that if we went into a similar house for sale and we were going to sell it for a similar price, what would that look like? So the first thing you want to do is go to some open houses in the neighborhood and see what kind of finishes your competitors are using. So if they're using granite countertops, then you have to use granite countertops, otherwise price it cheaper. Stainless steel appliances and so forth. You don't want to be too nice, and you don't want to be not nice at all to the point where it's just not comparable to the competition who's asking a similar price. Now, figuring out ARV is a tricky thing because it is not exactly the way an appraiser does it. The way an appraiser does it is they're going to look at what we call comparable sales, which is known in short as comps. Those are properties that have recently sold in the area, and the area should be the same subdivision, but theoretically appraisers can go up to a mile, but depending on where you are, a mile is a long way. It could be a totally different neighborhood. So start with, what's next door, what's on the block, what's in the subdivision, and then maybe you have to go outside the subdivision to a similar subdivision to find comps. What you're looking for is properties that have sold in the last 6 months. Anything older than that, technically, an appraiser is not going to look at, although we could look at it for our purposes. Just be aware of the seasonal differences in pricing. What does that mean? Well, for example, if you're buying a house in March and you plan on fixing it up and selling it in, let's say, June, it's going to sell for a higher price generally than it will in March. Prices tend to go up in the summer, down in the winter, generally speaking. So if you're looking at properties that have sold in December the year before, they're going to be substantially lower than what might be in June coming up in front of you. And that's not even assuming any market increase in value. That's just the seasonal fluctuation. So take that into account when you're looking at your comps. We have to look at things that are similar. Now, what is similar? Well, we're going to look at things like bedrooms and bathrooms. You're going to compare a 3-bedroom to a 3-bedroom, a 4-bedroom to a 4-bedroom, a 2-bedroom to a 2-bedroom. A 3-bedroom 1-bath and a 3-bedroom 2-bath are comparable because we can just adjust for the bathroom. But generally speaking, a 2-bedroom and a 3-bedroom are not really comparable because the biggest jump in value is between 2 and 3 bedrooms. You can generally compare a 3-bedroom to a 4-bedroom or a 4-bedroom to a 5-bedroom. And in terms of square footage, you want ones that are similar in size, plus or minus 25% in square footage or so. Don't make the mistake, as a lot of people do, is multiplying price per square foot of the neighborhood, which is the average price per square foot, times the number of square feet. That's not accurate because a 1,000 square foot house next to a 1,200 square foot house that have the same configuration, 3 bedrooms and 1 bath, are pretty much going to comp out almost the same value. Now, the one that's 1,200 square foot might have a laundry room, it might have a bigger kitchen, so it might be worth a little bit more, but not 20% more. Does that make sense? So you want to look for things that are similar in size, plus or minus 25% or so, and style. So you want to try to compare ranch to ranch, colonial to colonial, and so forth. And you want to do is come up with the 3 closest comparables meeting this criteria, and that's exactly what an appraiser will do. Now, that's not enough, because that's only looking in the rear view mirror. We want to look in the front windshield, out in front of us. So in that case, we want to look at what is for sale. That's your competition. So it may come at $200,000, but if there's a house on the market right now that is very similar to what your product is going to look like, and they're desperate and they're pricing it at $175,000, will that affect what you can sell your house for? Absolutely. So we want to look both at what's behind us as well as what is in front of us. And you're going to need some data to do this, either a good real estate broker or agent, or some good websites like Trulia, Trulia, and Zillow, Zillow. Warning, these websites, and many like it, have an estimated value that they come up with for a property. Do not, I repeat, do not rely on that. It may not be accurate. It's based on a formula which is mathematical. So for example, if there are high wires overhead or it is on a busy street, Zillow or Trulia may not be able to calculate that factor. So be careful about relying on the automated valuation models. Instead, look at the raw data of the houses that are for sale and the houses that are sold that are similar, that are comparable, and so forth.